Hello friends, welcome to my channel Online Explorer. Today our topic is commercial insurance. Let me discuss first what is commercial insurance. Insurance is regulated by the states. This system of regulation system from the MC Karen Ferguson Act of 1945, which describes state regulation and taxation of the industry as being in the public interest, clearly gives it preeminency over field law. Each state has its own set of statutes and rules. State insurance departments oversees insurer solvency, market conduct, and to a great lesser degree, review and rule of requests for rate increase for coverage, among other things. In commercial insurance, workers' compensation is the most highly regulated, largely because it is with the expectations of taxes and mandated by state law, licensing and capital requirements. An insurance company must be licensed before it can do business. This too is regulated by the states. Insurance companies that are licensed and authorized to do business in a particular state are known as admitted insurance and are said to be domiciled in the state that issued the primary license. They are domestic in the state. Once license is one state, they may seek license in other states as a foreign insurer. Insurers incorporated a foreign country are called aliens. Insurers in the U.S. Jurisdictions in which they are licensed. Surplus life insurers are subjected to different license agreements than stand companies. They only need to be licensed and admitted in their domiciliary state where they are admitted company and do business as standard lines company and ourselves for solvency by the state. Elsewhere they are non-admitted and are free of rate and policy regulations. All insurance companies, including surplus life insurance, are subjected to capital and surplus requirements which vary widely by state. Some states have requirements for individual lines of insurance. For example, New York has capital and surplus requirements for workers' compensation insurance, working writing workers compensation in new you must market have $50,000 in capital and $25,000 in surplus. In one, there are different requirements for surplus lines companies according to company ownership stock mutual companies. For example, it is responsibility of the National Association of Insurance Companies to develop a model rule and regulation of the industry, may of which must be approved by the state legislature before they can be implemented. The NAIC moved to strengthen solvency regulation in the 1980s, developing a accreditation program that required that state's insurance department to meet certain prescribed standards. It also established minimum capital requirements for insurers based on the riskiness of their business. Solvency guarantee funds. The funds of insurance companies. Solvency is the function of a state. State regulations. State regulation monitor the financial health of companies licensed to provide insurance in their state license through their analysis of the detailed annual financial statement. In the insurers are required to file and periodic in-site examination. When a company is found to be in poor financial condition, regulation can take various action to try to save it. insolvency to occur, however, despite the best efforts of regulations. Here is our topic, and we will discuss rate regulations, proposals to modernize the regulation of insurance. Regulation of insurance.